Hey there, Ed McCormack here, founder of the crypto education platform, DChained. Before we start today's video, if you haven't already, hit that subscribe button, ring the like bell. We love all the support that we continue to get from all the new viewers and those of you who continue to come back to this channel, video after video, week after week, and we hope to grow this even further. Now, with that being said, this week we saw an announcement that is similar to many announcements that have happened in the past, which is China has made a public statement saying that crypto is illegal. Now, usually when that happens, there's a reverberation that happens throughout this entire crypto market, leading to price pullbacks on Ethereum, Bitcoin, overall altcoin space. But not this time. What we've seen is, in fact, a centralized exchange that has been spiking in terms of overall trading volume and price appreciation. And this is a network that you need to have on your radar heading into the end of 2021, because truthfully, it's only getting started. And if you're asking, what are we talking about? Look no further than Woo Network. And we're going to talk all about it right now. So for those of you who have tuned into our past videos, Woo Network is no stranger. This is a project, a protocol that we have been covering ad nauseum because ultimately it solves a major problem in the overall DeFi space, which is liquidity. Liquidity is just the ease in which one asset can be converted to another asset or cash without affecting that asset's original price. It's the reason that if you are trading on Uniswap and it's a coin or a token that really doesn't have a lot of trading volume, you might actually have what's called slippage, meaning you're probably paying a little bit higher than you really should, because ultimately it comes down to having a counterparty, a seller who's going to meet your buying demand. Now, this, as I mentioned, is felt throughout the entire DeFi and ultimately traditional finance space, especially when we're talking about crypto. When we're talking about crypto, if you look at the centralized exchanges, Coinbase and Gemini, a lot of liquidity, so a lot of capital sitting there, because those exchanges will act as a counterparty. Anytime you want to buy or sell, they will be the counterparty. They operate on what's called an order book, and essentially how it operates is anytime you want to buy, they're willing to sell. Anytime you want to sell, they're willing to buy. Now, sounds great, but the fact is that that model generally only operates really well when you have deep capital. When you have a lot of money associated with those assets. And it's a problem when you want to try and trade assets that might not have as much trading volume. It's the reason that when you go on Coinbase, there are a lot of times not that token that you may have heard about. You have a limited number of options that you could trade upon. It really is a very curated investing and trading experience. And that's because of how it operates from a trading perspective. On the flip side, for decentralized exchanges, you can buy anything and everything, but the problem is that it operates on what's called a liquidity pool, meaning investors are putting up their assets in either a pair, so Ethereum and Tether, for example, or they're doing single asset staking. Won't go too deep into that, but basically what you're doing is you're providing your assets, you pull it into an overall grouping with all other investors who are putting their assets up, and then you allow anyone who wants to trade to take reserves out of that pool in order to execute that trade. So if I put in 5 Ethereum and 5 Tether, you do the same. We have 10 Ethereum, 10 Tether in there, and anyone that wants to trade Tether and Ethereum, ultimately that will come out of that pool. Now, sounds great, again, but the problem is that with so many now DeFi platforms, or decentralized exchanges, I should say, what's happened is that there's an issue where these liquidity pools are fragmented to just those platforms. So the Uniswap liquidity pool is available just for Uniswap. Same thing for Sushi, same thing for Pancake, etc. And it comes to this point where there's these little fiefdoms, if you may, where there's not a lot of overall general liquidity because everything is tied to platform-specific pools. And this is where Woo Network comes in. Woo Network, aside from having an exchange that investors can trade on, they actually are really a liquidity aggregator. They provide liquidity to decentralized exchanges, centralized exchanges, liquidity pools, and even have a very deep amount of capital sitting on their own exchange where they can ultimately help facilitate what's most exciting to a lot of investors: zero fee, low slippage type trades, meaning all those gas fees that you pay on Uniswap are gone because ultimately it's happening within the walled garden of Woo Network. Now, you might say, well, get to the point. Why is this important? Well, there are really three things that are really important here. One is investors, if you're going to buy Woo, which is the native token for Woo Network, there are a tremendous amount of benefits here. And it's built really to be an investment that is going to pay itself off really from trade one. So when saying that, if you look at its overall circulating supply, so the amount of Woo that is out there right now in the market that can be bought or sold, it's roughly about 515 million Woo. Now, of that 515 million Woo, if you were to put up 1,800 tokens, if I were to buy 1,800 tokens and stake it on woo.org, which is Woo's website, Woo will allow you to get those 0% commission or zero trading fee trades. And in doing so, if you back that out, that's roughly $100 per month in Uniswap fees. If you just take that money, put it by Woo, it pays for itself. But in saying that, if you look at how many traders were to do that, there's only roughly about 281,000 traders who can buy 1,800 tokens. So you're talking about a massive amount of buying demand on a very limited supply. 281,000 traders is really not a lot when you talk about the billions of people around the world. The second thing that's really exciting is the fact that what we're looking at here is a scenario where many of the traders who were putting up their money and investing in Asian exchanges are now looking for a new home. And let me unpackage that for a second, because when it comes to liquidity, many people forget to note that in the US, we only account for a very small percentage of overall trading. 70% of all the liquidity in all of crypto sit on 3 exchanges: Binance, OKX, and Huobi, all 3 of which are Asia-based. Now, all of them, at one point or another, had a headquarters in China, and they've subsequently have moved out into other areas. Huobi being the most recent to have moved. Ultimately, the straw that broke the camel's back was this decision by China to make all crypto illegal. And you saw Huobi decide to not only leave China, but also shut down its mining, its Ethereum mining arm, which was actually the second highest hash rate of all Ethereum miners. So you're talking about a massive amount of revenue for that exchange, having to now pick up and leave China altogether. And with that, what you've seen is this new resurgence around DeFi in China. In fact, many analysts are even talking about how in China, many investors are starting to learn about DeFi overall. They haven't really had to trade in DeFi. You have Binance, which is 800-pound gorilla that many of them have been using for ages. You have Huobi, you have OKX. I mean, the list goes on and on. But that's not the case anymore. And where many of these Chinese investors have gone is DyDx. Now, DyDx is a decentralized platform for perpetual futures contracts, which allow you to basically buy a futures contract. And you have to understand derivatives are massive in Asia, where they're not as tightly regulated as they are here in the US, which is fairly restricted to the type of investor you are. In Asia, many of these investors often traded on margin or some type of derivative. And DyDx not only provides you that, but it gives you this extra layer, which is called perpetuals. Perpetuals, just basically a futures contract where you trade on margin, but there's no end date, meaning there's not an expiry date that you need to be mindful of and have to roll future contracts into future quarters because the expiry date is coming too close. That thing can just run for an unspecified amount of time, which ultimately has led to DyDx becoming the number one exchange in the world when it comes to decentralized exchanges. Binance is still much, much larger, but DyDx just recently did over $9 billion in trading in a 24-hour period. And why that's interesting for this conversation is that its number one liquidity provider, the source of all of that funding that's allowing it to run and operate, is Woo Network. And here is where probably the most exciting thing is, which is not only is Woo Network getting a tremendous amount of trades happening now using their pipes, clearing $1 billion only a few days ago for the first time, over $2.5 billion today at the time of this airing, but because of the fees that are generated with Woo, 50% of them are used to buy back Woo, so there's a whole deflationary mechanism. What we're looking at here is potential for a huge amount of buying pressure now coming from Woo itself, meaning that its limited supply that we talked about just a few moments ago around, there's only really 281,000 people around the world who could buy those 1,800 tokens, which is roughly about 1,400 if you look at today's 80-cent price. Now you're going to have increased demand from Woo, who wants to buy back their tokens and burn them to ultimately reduce the overall supply. And here's what's exciting, is that when you look at other exchanges, centralized exchanges with exchange tokens, Woo is priced incredibly cheap. So for example, if you look at FTX has a market cap of roughly $6.8 billion with about $2 billion in trading every 24-hour period. It's roughly, at the end of the day, north of a 3x market cap to trading volume ratio. If you go to Binance, it's about over a 2. Even crypto.com is about a 1.1. When you look at Woo, it's a 0.16, meaning you're looking at roughly a $400 million valuation for a platform doing $2.5 billion in a 24-hour period. You are talking about a platform that is worth roughly 5% of what FTX is currently being valued at. Meaning, if you're an investor looking at this coin, you're looking at a path to a 20x just to match what FTX is currently valued at. And FTX hasn't really even begun, because as FTX, which was last valued because of its fundraising at roughly 18 billion, once it starts to position itself for IPO, meaning starts to go towards that 100 billion mark, which is around where Coinbase was, you could start to see Woo Network start to ultimately appreciate just through association because of its trading volume being so close to FTX. So the net is you're looking at a platform that ultimately not only is getting more trades happening on its own platform, but it's actually the fuel that's driving one of the biggest decentralized exchanges in the world right now, taking a lot of the trades coming from Asian investors who'd otherwise be using platforms like Huobi, and ultimately looking at a scenario where its finite and limited supply of Woo token, which is used by traders to get those no-fee trades, is ultimately now going to have additional buying pressure, because you now not only increase the overexposure of Woo, increasing the number of chances where those 281,000 slots for people who can own 1,800 Woo token at any one time is increased. But what you also can see now is, with all of those increases in trades, an opportunity where buying pressure will only increase. And that ultimately leads to a massive opportunity heading into the last 3 months of 2021. So I hope you found this video helpful. And if you did, subscribe to this channel. If you haven't already, tell your friends and family, like this video, leave a comment, yada, yada, you get it. Thank you very much for continuing to come back and support this channel. And until next time, happy and safe investing. I'll speak with you soon.